20th and 21st, 2013. The MPC met on May 20 and 21, 2013, with 10 out of the 11 members in attendance. The committee reviewed the conditions and challenges that confronted the domestic economy in the first 5 months of 2013 and reassessed the short to medium-term monetary policy options in the light of the fragile global economic and financial environment. The committee noted that one of the members, Professor Sam Olofin, has left the board of the central bank and therefore ceases to be a member of the MPC. The committee recognized his tremendous contributions to its deliberations over the years and thanked him for his services. International economic developments. Global economic recovery continues to be fragile due to the suppressed growth and weakness in key financial markets, including the Euro area and Japan. However, the emerging market economies and sub-Saharan Africa countries continue to show resilience. Global growth outlook remains subdued but promising. It is forecast to average 3.2% in 2013. In the advanced economies, output is expected to grow by 1.2% in 2013 compared to 1.3% in 2012. In the United States, the budget deficit figures are better than projected due to automatic spending cuts and improved revenues boosted by dividend payments to the Treasury from mortgage banks it bailed out during the crisis. Unemployment figures are also improving. Although the European Central Bank has commenced a wave of monetary easing, the Euro area is expected to remain in recession with output contracting by 0.3% compared with a contraction of 0.6% in 2012. The EU has made steady progress in establishing a banking union, pursuing a three-pronged initiative of single supervisory mechanism, deposit guarantee system, and a recovery and resolution scheme. The development has been adjudged an important step towards recovery and return of market confidence. The regime of quantitative easing commenced by the Bank of Japan holds prospects for Japanese recovery, arising from a weaker yen and improved competitiveness of Japanese exports. However, risks lie in Japan's demographics, whose key feature is a low propensity to consume, given its large population of pensioners at 30%. With slowing growth momentum in the emerging markets, global output is forecast to remain around the 2012 level. The emerging and developing economies as a group are forecast to grow by 5.3% in 2013, with sub-Saharan Africa growing at 5.6%. These economies have continued to face the challenges of adjusting macroeconomic policy to compensate for the weak external environment, particularly shocks induced by developments in the advanced economies. The IMF suggests that with prospects of improvements in the global economy, policy recalibration in a number of emerging market economies should address risks from sustained rapid credit expansion and high asset prices. Growth in these economies has somewhat moderated compared with last year. The strong GDP growth rate of 7.7% recorded in the first quarter of 2013 by China was countered by weaker rates in other economies. Domestic economic and financial developments. Output. The National Bureau of Statistics forecasts real GDP growth rate of 6.72% for Q2 2013, an improvement over the Q1 estimate of 6.58%. The major driver of overall growth remains the non-oil sector, led by services, agriculture, and wholesale and retail trade. The committee noted that the relatively robust output growth projections for 2013 was hinged on expected favorable conditions for increased agricultural production and other policy initiatives aimed at stimulating the economy. However, the committee noted with caution that the high GDP growth projections, in view of the extant risk factors such as widespread insecurity, weak infrastructure, and probable flooding from the projected heavy rains in some parts of the country. In addition, the state of emergency in the northeast and the accompanying military operations in that axis have the potential to adversely affect economic activities generally, including agricultural production and food prices, as well as consumer demand. The committee also noted that although most sectors of the economy showed improved growth performance in Q1 of 2013 when compared with Q1 of 2012, this was not the case with respect to key sectors like agriculture, telecommunications, and distributive trade. Concern was also expressed over short-term prospects in the oil sector, mainly around possible reduction in oil prices and continuing leakages in oil production due to bunkering and other criminal activities. Prices. Headline inflation increased from 8.6% in March to 9.1% in April, remaining within the target range for the fourth consecutive month. Food inflation was 10% year-on-year in April, compared with 9.5% in March, while core inflation declined further to 6.9% from 7.2% in March. On a month-on-month basis, inflation showed broad-based moderation across almost all components, with the exception of imported food, which may be largely a reflection of the new tariff regime. The inflation outlook remains relatively benign, with projections of headline inflation remaining in the single-digit range for the next 6 months. This result reflects a combination of base effects and the success of tight monetary policy, leading to muted growth in monetary aggregates and exchange rate stability. The principal risks to the outlook remain fiscal spending and possible pressures on the exchange rate from any attrition to reserves caused by declining revenues as a result of output leakages. Monetary, credit, and financial market developments. Broad money supply M2 grew by 4.44% in April 2013 over the level at end December 2012. When annualized, this growth was 13.3% compared with a contraction of 0.03% in the corresponding period of 2012. The growth in M2 was slightly below the growth benchmark of 15.2% for 2013. Aggregate domestic credit net grew by 17.46% in April, which annualized to a growth rate of 52.38% over the end December level, compared with a contraction of 6.12% recorded in the corresponding period of 2012. Interest rates in the interbank money market moved in tandem with the level of liquidity in the banking system. The average interbank call and OBB rates, which opened at 10.21 and 10.23% on March 19th, closed at 10.86 and 10.91% respectively on May 16th, 2013. The average maximum lending rate rose marginally to 24.53% in April from 24.49% in March. Similarly, the average prime lending rate rose to 16.65% in April from 16.61% in March. The committee noted the continued recovery in the Nigerian capital market as equities market indicators were positive in the review period. The all-share index increased by 19.1% from 28,078.81 on December 31, 2012 to 36,907.81 on May 17, 2013. Market capitalization also increased by 19.1% from 8.97 trillion naira to 10.69 trillion naira during the same period. Improved earnings, increased capital inflow and portfolio investments, as well as investor confidence in the economy, contributed to the upswing in stock prices. The committee also noted the reported increase in the share of domestic players in the capital market, thus reducing the risk of major shocks due to slowdown in foreign participation. External sector developments. At the wholesale Dutch auction system, interbank and BDC segments of the foreign exchange market, the exchange rate opened at 157.32 naira to the dollar, 158.70 naira to the dollar, and 160 naira to the dollar on 20th March, and closed at 157.3, 158.33, and 159.5 naira to the dollar, respectively, on May 18, 2013. In all three segments, the Naira exchange rate appreciated in the review period. This development reflected the effects of improved supply of foreign exchange to the market. Both the average and monthly premium for the review period remained insignificant, indicating the effectiveness of current policy measures. The committee also expressed satisfaction with the significant accretion to external reserves, which stood at $49.13 billion as at May 16, 2013. This represents an increase of $5.3 billion or 12.1% above the level of $43.83 billion at end December 2012. This level of reserves could finance approximately 13 months of import. The committee's considerations. The committee was pleased with the prevailing macroeconomic stability, moderation in all measures of inflation on month-on-month basis, stable banking system and exchange rate, and robust external reserves. It commended the agreement reached between the CBN and AMCON on the settlement of outstanding AMCON obligations to all private sector investors by December 2014, and to repay the 3.6 trillion naira debt held by the CBN under a new refinancing and restructuring arrangement within a period not exceeding 10 years at single-digit interest rate. The committee noted that the repayments and refinancing arrangements would have no adverse monetary policy implications, but rather increase confidence in the financial system. Also, under this arrangement, it is unlikely that banks will be required to contribute more than 50 basis points on their balance sheets annually to the sinking fund. By October 2014, the central bank will be the sole creditor to AMCON, holding bonds guaranteed by the federal government. The federal government will therefore have no contingent liability to any party other than the central bank, and the bank in turn will recover its debt from AMCON recoveries and from contributions to the sinking fund by the banks. Since the central bank supervises and regulates the banks and AMCON, this exposure is considered a fair risk. The committee was, however, concerned about the threat posed by developments in the oil sector arising from uncertain oil market environments, high output leakages arising from oil theft, which has negatively affected the oil sector's contribution to GDP, and the prospects for declining output if the state of affairs continues. The committee observed that the accretion to reserves resulted principally from increased portfolio capital inflows. The committee noted the potential effect of this development on exchange rates, on reserves, and on the capital account in the event of capital flow reversal, and thus stressed the need to maintain stability and retain confidence of investors in the consistency of monetary policy. The committee also expressed concern over the low level of credit growth to the private sector and linked this to the crowding out effect of high growth in credit to the public sector. The committee noted the 1.02 trillion naira increase in claims on central government and the 1.11 trillion naira drawdown on savings between January and April 2013, particularly the monetization of $1 billion in April 2013 from the excess crude account. The combined effect of new borrowings and reduced savings was an increase in net credit to government of over 2 trillion naira in the first 4 months of 2013. The evidence points to an increase in the rate of government expenditure this year when compared to 2012. In addition, the recent military action in the Northeast will result in additional spending. Although the government has announced that there will be no supplementary budget, the coordinating minister for the economy has already confirmed that there will be a drawdown on a contingency vote already embedded in the 2013 budget. Overall, the committee is of the view that government spending will constitute a major risk to the inflation and exchange rate outlook, thus advising prudence in monetary policy action at this point. The committee further noted that in spite of increased borrowings, yields on FGN bonds have been moderating steadily, signaling the impact of increased inflows while equity prices have been trending upwards. The evidence does not therefore support claims of monetary policy being too tight. The committee was of the view that the principal risk to the long-term stability can be addressed through diligent implementation of sound policies of fiscal consolidation and efficient sectoral policies underpinned by structural reforms. These are required to attract long-term foreign capital inflows that would make the gains of monetary policy sustainable and also support credit extension to the private sector players. Consequently, the committee weighed the following options. Option 1, a reduction in rates in view of declining core inflation, stable exchange rates, relative reserve accretion. Against the backdrop of sustained pressure to ease the stance of monetary policy, the committee considered the imperative of signaling its sensitivity to the concerns expressed about high lending rates in the economy. 2, retaining current monetary policy stance to sustain the macroeconomic gains of tight monetary policy and to continue to rein in inflationary expectations. The committee's decision. The committee considered and acknowledged the merits of option 1, but rejected it as being premature in view of the potential risk factors in the horizon posed by recent developments which would necessitate increased fiscal expenditure in the short to medium term, resulting in a resurgence of inflationary pressure. The committee considered and decided by a majority of 7 votes to 3 to hold policy, with 3 members voting to reduce MPR by 50 basis points. Thus, by a majority vote of 7 members to 3, the MPC voted to maintain the current policy stance, i.e., retain the MPR at 12% with a corridor of plus or minus 200 basis points around the MPR, retain the cash reserve requirement at 12% and liquidity ratio at 30% with the net open position at 1%. In the final analysis, the committee was convinced that in view of the successes achieved on all fronts, banking stability, low inflation, exchange rate stability, strong reserve buffers, and recovery in the equities market, there is no reason at this point to change a policy that has worked so well. Thank you.
Questions, please. All right. Keep your questions straight. CNBC, is it? Yeah. Please.
Okay. Ibrahim, I work for CNBC Africa. I would like to know your thoughts about the recent refinancing plan announced by AMCON. Thank you.
Okay, I mean, the refinancing plan was agreed between AMCON and Central Bank, and I think I should just try to clarify what it contains and what are the implications. Today, AMCON has debts outstanding with a face value of about 5.7 trillion, and basically these are zero coupon bonds, which means the principal amount is about 3.9 trillion. 3.6 trillion of these bonds are held by the central bank, and therefore about 2.1 held by banks other than the CBN, private sector banks. Now, the way we've structured the refinancing is as follows. In December this year, AMCON will pay off. AMCON today, as you know, has over 800 billion in assets coming from the Tier 2 capital, central bank put in, the contributions of the sinking funds, and AMCON recoveries. And by the end of this year, it will build that balance from recoveries to a little over 1 trillion. Now, that is enough to pay off all holders of AMCON bonds maturing in 2013 series. That's the Series 1, other than the CBN, and also to call in all holders of Series 2, 3, and 4, maturing at some point in 2014. In December, what will happen is that AMCON will issue a new bond of 3.6 trillion Naira to the CBN, which we'll invest in, and that will be used to refinance our entire exposure at an interest rate of about 6% over 10 years. So that means the only other creditor to AMCON will be those holding Series 5 bonds of about 1 trillion, maturing in October 2014, and AMCON will build up balances from recovery and the sinking fund and pay them off in 2014. The net result of this is that by October 2014, the only creditor to AMCON will be the central bank. Every other person holding AMCON bonds will be paid off as and when due. This payment is not going to be in the form of a creation or an injection of 1 trillion naira of cash into the system. We already compel AMCON to hold its cash holdings and basically convert them into securities. So these securities will be exchanged. So effectively what you're going to have is by December, the balance sheet of AMCON will shrink by 1.1 trillion. It basically hands over assets it is holding, securities, to its existing creditors and then takes the bonds and cancels them. And by October next year, the balance sheet will shrink by another 1 trillion, down to 3.6. So you have a situation in which AMCON's obligations are being extinguished. The central bank holds these bonds to be paid off over a maximum of 10 years at an interest rate that is manageable, that does not impose too much of a burden on the banks. Our bonds will be structured in lots of 20 to 25 billion. So every time AMCON gets 25 billion naira or 20 billion from recovery, it extinguishes a bond. So it reduces the principal, reduces the interest, and maybe within 7 years actually will get paid. We think this is a formula that basically works. It gives confidence to the system. People know that the government does not owe anyone other than the central bank. There is no contingent liability on finance to anyone other than the Central Bank of Nigeria. We supervise AMCON, we supervise the banks, we'll get our money back, and we think we have a solution that will satisfy everyone.
Last question.
My name is Hawa. I work for Voice of Nigeria. Recently, there's been speculation about your state of health. Is it something for us to worry about?
No, it's not. You may have worried before, but it's. I think the good thing is that the papers got the news after I came back. Let me clarify something. I didn't leave this country to get medical attention. I went on an annual vacation around May, which I usually do, and I was in Paris. And then I had a crisis, which the doctors call it peritonitis of the appendix, which basically is an infection that spreads in and then kills all your organs, and you die if you don't get treatment. But I was in a part of the world where, and unfortunately, there was a very good friend who was in Paris at that time who had access to good hospitals and good surgeons. And so the crisis happened on April 30, and I had to go into emergency surgery on May 1, where there was an appendectomy taken. The appendix was cut off. The germs were drained out. I had to have strong antibiotic treatment for a week in hospital, and then spent a week outside hospital. I'm medically cured. I don't have an appendix, so I don't know what that means, but that's about all. The surgery has healed. I need a few weeks to get my energy levels back to normal, but I'm fine.